Kia ora, and thank you all for joining the CFA Society webinar on the opportunities and risks of infrastructure investment. Obviously, it's a topic of interest. As of this morning, we had 220 people signed up to participate, so a good turnout. So we've got an hour with our panel experts, and our objective is to provide a brief overview of infrastructure as an asset class. And look at the opportunities, the challenges, roadblocks and risks facing the industry and investors in the sector. And as David mentioned in particular, we'll look at the impact of COVID and also climate change. So I'd encourage you to use the Q&A function on Zoom to ask those questions that you've always wanted to ask on this topic. It's a very democratic process, so you can also vote for other people's questions that you want answered, and I'll select questions for the panel as we go through. So just a little bit of background: infrastructure as an unlisted asset class really emerged in the 1990s, although of course listed companies have provided exposure to infrastructure and utility assets for longer than that. It has continued to gain greater acceptance from institutional investors over time, and for example, Australian super funds have an average allocation to unlisted infrastructure of around 5%, and with some funds holding up to 10% of their growth funds. By contrast, here in New Zealand, few KiwiSaver or other funds other than the Crown funds have a dedicated allocation to infrastructure, although many have some exposure as part of their broader equities allocation. I think it comes back to scale, tolerance for complexity, liquidity, and of course cost considerations, which have proven to be real obstacles here in New Zealand. Some of the key features that define an infrastructure asset, I think, are well known, but barriers to entry and elastic demand, economies of scale, significant physical assets, and a long useful life. And most definitions for the asset class would include energy and water utilities, transport assets, social infrastructure, and communications. As an investment, the assets generally produce reliable earnings because they provide services that are essential to communities and typically face limited, if any, competition. Some assets may be regulated, some generate income which is linked to inflation, while others offer better long-term growth opportunities but might be more cyclical or exposed to more competition. The sector, we believe, can serve as a diversifier within a multi-sector portfolio as a result mainly of its defensive characteristics, but also that linkage with inflation. But clearly it's not without risks, and the pandemic has certainly disrupted some, usually defensive assets this year with really diverse outcomes at a sector level. Just by way of example, and our panellists will expand on this, but earnings for airports globally are forecast to be down this year between 70 to 90%. Toll roads down 40 to 60, while utilities relatively unaffected. And communications towers, which have benefited from social distancing, up sort of 10 to 15%. And then just briefly, turning to the other point around the more long-standing risk of climate change, infrastructure is expected to bear the brunt of anticipated climate change adaptation costs, typically estimated to be between 60 to 80% of total climate change adaptation spending globally. So the sector really does present risks and opportunities in terms of both, the risk of physical damage as well as the required transition to a lower carbon economy. And, not surprisingly, the listed infrastructure sector has a carbon footprint much higher than the broader share markets, but at the same time, it has the greatest potential to make a difference. So I'm now going to hand over to the panel to each provide an introduction and some key points, and I'm going to start with Paul, who I'll also start with a couple of questions. So firstly, Paul, how much infrastructure is in New Zealand at present?
Kia ora everyone, and thanks for the invitation to have a chat to you today. at Infrastructure New Zealand, we did a bit of a benchmarking of what was out there. And in New Zealand, it really is a market dominated by local government and central government owners. So what we found was about $304 billion worth of infrastructure assets as sort of traditionally defined. And I think Michael will go into sort of perhaps some of the wider definitions of infrastructure later on. But really 80% of that was owned by central and local government, roughly split half-half. And then 20% of that 300 billion was owned by the private sector. We then had a bit of a look at how that infrastructure sector was performing, and this is against a sort of a traffic light, red, amber, green type basis of whether it was standing up and creating world-class outcomes for the users of that infrastructure, as opposed to, I suppose, the owners. And on a traffic light basis, broadly, we see the private sector owners, private sector owned infrastructure sort of green on a traffic light basis. And the key factors, I suppose, from a private ownership perspective was that often they tended to be regulated, and that provided them with a really certain funding stream, but also provided a bit of a backstop in terms of the quality of the service provided and the long-term quality of the assets that underpinned it. So regulation is really, really important, and I'll talk about that later on, that I think that there's a chance for that regulation to be modernised under some of the pressures it's currently under. A final piece is that in that government space, it's really important to have a look at the funding streams or the income streams that provide the coupon to the investor, whether that's a debt investor or an equity investor or a hybrid of the two. And so, as I said, 80% of New Zealand's government infrastructure is owned by central government and by local government. But the interesting thing in New Zealand is that the taxes and income that goes to governments in New Zealand is split 90% to central government and 10% to local government. So just pausing on that again, local government provides almost half of the total government assets, but on 10% of the tax income of New Zealanders. And so that is one of the core drivers for why we have a few problems in our housing space and our water space and our urban transport space. So it's long been an Infrastructure New Zealand piece to try and link the infrastructure provision closer to the funding and to balance better the central and local government funding model. Thank you.
Thanks, Paul. And touch on it. What key changes have you seen in the investment frameworks for infrastructure lately in New Zealand?
Sure. So again, just really important to look at the differences between the funding side and the financing side. So the financing side, this wall of money that really wants to get invested in equity, in the equity or debt securities of infrastructure. But in New Zealand, the market dominated by government, we haven't really released the funding streams or created the funding streams to enable private investment as much as we would like. Probably three key changes. I'll focus on the government side. So New Zealand Treasury always has a big role to play in government investment in infrastructure. And until very recently, there's been a rule of thumb that they needed a 6% real rate of return to conduct their benefit cost ratios and release investment. Now 6% real post-tax in this environment is a heroic rate of return. That's the rate of return that the government theoretically requires in order for them to put our taxpayers' money at work into an infrastructure asset. We saw a change with that with NZTA, the transport agency, or Waka Tahi, recently moving down to 4% for its discount rate that it's applying, which is a substantial drop. Under the 6% discount scenario, all positive cash flows were discounted away by the end of year 15. With a move to 4%, that goes considerably longer. So if you've got a 30-year road, you've actually got a chance of that paying itself back. They also did scenarios at 3% and at 6%. And there's a real open debate about what the right infrastructure discount rate is that should apply to a 30, a 50 or 100-year asset, particularly in an environment where we've probably had 100 basis points drop in the risk-free rate at least in the last even 6 to 12 months. The second point is our Commerce Commission is often the regulator that provides the regulated rate of return for infrastructure assets in New Zealand. There was recently a sort of, probably about 6 to 9 months ago, they were setting the allowable weighted average cost of capital returns in the low 4s for electricity distribution businesses. Again, we've probably had 100 basis points drop. So we're getting down into the low threes. Again, that's really interesting when you compare it to the government demanding 6% real or even 4% real for taxpayer use of money. So I think there's an opportunity for private investors that are front-footed, and I know that there's at least one of them on the call today, to put in sort of bids to government and say, look, private capital can provide public benefits, and it can provide it probably at rates that are competitive with what you're discounting these returns away at. And the final one, which I think is really interesting, it hasn't yet fully been baked into government decision-making, is what's called the Living Standards Framework. So this is the 4 well-beings of economic, social, environmental, and cultural outcomes. And in New Zealand, we've tended to really only focus on the economic outcomes and leave out those other 3 outcomes. But that's one of the core roles of infrastructure investment. And I think that for forward-looking CFAs on this call, they'll find a way to work with Treasury and have those non-monetary benefits converted into a monetary form, so that the benefit cost ratios are not just solely on the economic outcomes of infrastructure, but they're on the wider benefit of it to the wider economy. And what that probably means is that we move away from investment returns being to the last 2 or 3 or 4 decimal places, and we talk about a range of outcomes between 1 and 3, and the better answer is 2, for example, as a benefit cost ratio. So those are all challenges to a highly quantitative team that you've got. It's bringing the qualitative in to find better outcomes. Thank you.
That sounds good. So there's a good lead-in for Sophie to give an introduction and touch on some of the key points that you're looking to cover.
Thanks, Philip. Kia ora, everyone. So I'll kick off with a topic that's hard to get away from at the moment, which is the impact of COVID. So I've recently been doing some work on one of the PPPs that's currently under construction that's been impacted. There's 3 under construction in New Zealand at the moment, and I'm sure you've all heard all about them. Transmission Gully and the Puhoi to Warkworth PPPs are both roading PPPs, and the Waikaria Prison Development is the 3rd one. And these are large fixed price, fixed time contracts, and usually the risk sits with the contractor if the construction's delayed. But that's not the case when the government's imposed COVID-related restrictions. So that COVID disruption applied not just in level 4, when the construction couldn't continue, but also in levels 2 and 3. And in levels 2 and 3, there's some disruption to labour and productivity when you've got additional health and safety processes that need to be applied, but also to accessing materials and the impact to the international supply chain, which usually means some form of delay. For Puhoi to Warkworth, NZTA has recently reached an agreement with a 7 months delay and an $85 million payment to the contractor. And Transmission Gully as well has agreed in a delay. So that will open in September 2021, and it will cost an additional $200 million to build. Construction of PPPs continued in good faith when COVID impact was being negotiated. But you'll find that the biggest and more specialist projects have been the most affected currently, and the smaller projects tend to have more locally sourced labour and haven't been quite as impacted by COVID. But having said that, the construction and infrastructure sector in general are expected to be hit by the downturn. So there's an opportunity for the shovel-ready projects that have been announced to get underway, as well as developing skills and materials locally. And there's recently announced government scheme for apprenticeships, which could help with that development as well. Another impact of COVID is population size. So New Zealand's population reached our team of 5 million in March this year, and it's our fastest million in history, taking about 17 years since reaching 4 million in 2003. And Stats New Zealand predict our population will reach 6 million in 2050. And all our infrastructure planning uses these population forecasts. But with COVID, there's been a big surge in the number of Kiwis returning home, and there's been lots of positive commentary on New Zealand's management of the pandemic globally. So people are looking to New Zealand as an attractive place to move to. Typically, more New Zealand citizens depart the country than arrive, but since COVID, that trend's been reversed. And it may be that once the COVID threat's reduced, it will return back to normal. But it's a risk in that if there's an unexpected increase in the number of people, then it'll put an additional strain on the use of our infrastructure. And it could potentially mean that there's a shortfall in the design and capacity of any new infrastructure. But it's also an opportunity, as we'll have more people to help fund that infrastructure. As Philip pointed out, the infrastructure is typically a longer term investment. It's got predictable and stable returns over a longer time period, and it can be quite attractive for fund managers. But it requires quite a large upfront capital amount. So that has led to historic underinvestment, whether it's in new infrastructure or maintaining or upgrading the current infrastructure. And New Zealand's not had much coordination of its national regional infrastructure planning. Generally speaking, the government departments that Paul was talking about, the central government departments like transport, education, health and so on, develop plans independently of one another and seek funding through central and local government budget processes. But there's an opportunity to address that historic underinvestment and take a more integrated approach. So you'll have all seen examples of a lack of coordination, whether it's digging up the road twice in a short time frame, so you put down pipes, then you do it all again for cables, or not taking a cross-sector approach, so having reactive rather than preventative action. So do you invest in hospitals for when people get sick, or can you divert some of that investment to education and instill those learnings to help people stay healthy or seek help at an earlier stage of illness? The Infrastructure Commission, Te Waihanga, was set up last year, and it's a more independent body to help plan and deliver infrastructure and improve New Zealanders' long-term economic performance and social well-being. Hopefully this is an opportunity to take a more coordinated approach across sectors and help overcome some of those political constraints like the short 3-year election cycle. Another topic that I wanted to touch on is, which is close to my own heart, is to broaden our horizons and not just look for those financial incentives that, that Paul's also addressed, but look to the economic, social and governance objectives. There's a stark lack of diversity in our infrastructure sector, and that applies throughout all stages of an infrastructure project, from planning and designing to delivering and operating and maintaining, as well as the governance. And that's in stark contrast to the wide variety of people, whether they're different cultures, ethnicities, genders, ages, who actually use the infrastructure in transport, schools, health and so on. So that differential is something that's been highlighted in the infrastructure sector in recent years, and some improvements have been made, but there's a lot more that can be done. So I sit on an advisory board for the Women in Infrastructure Network in New Zealand. And over the past few years, this has helped to increase the visibility of women in the sector. But for our infrastructure, it's that diversity of thought and experiences that's really important. Unconscious bias can have negative impacts on minority groups, and that can disproportionately affect the most vulnerable people. A relatively light-hearted example is an equal snow ploughing scheme that was piloted in central Sweden. And the idea was that all the people get an equal protection from slipping on snow and ice, and make alternative forms of transport more accessible, since cars were already equipped to deal with those conditions. So previously the key roads were cleared first, followed by work areas and then pedestrian and cyclist areas. And the scheme reversed this and prioritised daycare centres and then large workplaces and then schools and main roads. And the change didn't incur any extra cost. And despite some backlash from the drivers, it's proved so successful in reducing the numbers of accidents from slips that it's being rolled out across the country. Who knew that people in Sweden still cycled when it snowed? Some of you may have heard of an example in the tech sector as well. When the iOS YouTube app for mobile uploads was first issued, 10% of the landscape view videos uploaded appeared to be upside down. You might have guessed that the team building the app were all right-handed. In New Zealand, key focus is on making public transport and urban spaces safer. And there's a lot of evidence and research out there that makes it increasingly clear that companies with more diverse workforces perform better, not only for those ESG outcomes, but also financially. And the last topic I wanted to touch on was the risks of infrastructure, taking them quite literally. I found that risk evaluation's not been done all that thoroughly in New Zealand. And as part of my role at EY, I've conducted many risk workshops for large infrastructure projects. And most projects will allocate a percentage cost contingency that's appropriate for the stage of the project, and that can work quite well. But for larger projects, I've gone through a process to specifically identify and assess the key risks of the project as to their likelihood of occurring and their impact if they do occur, and identifying risk mitigations and treatments. Not very often do we also quantify each risk and build up a risk-adjusted price and delivery timeframe and do a probability analysis around the quantified risks. People have often said to me after the process that it's the first time they've done this in New Zealand, although it's quite common overseas. And it's something that would help us better understand the risks and their potential impact, how we can best manage them when investing in infrastructure. I think I've definitely gone over time there, so I'll hand back to you now, Philip.
Thanks, Sophie. And just on the, the ESG point that you made, so, I mean, I would assume that, it's important that, the level of community support that an asset enjoys presumably also is important, it's an important factor influencing its long-term outlook. So obviously it's more valuable to the community if it is serving a wider set of needs. Okay, well, we'll now hand over to Michael and look forward to your comments. And I see we're starting to get a few questions coming through, but I'd encourage people to start sending some more questions now, because we'll be in a position to start talking to those shortly. Michael.
Thanks, Philip, and kia ora, everyone. Look, I was going to provide some comments on infrastructure as an asset class, building on some of Philip's earlier comments, and also to provide some insight into the investment manager perspective. So Morrison & Co. is the only specialist infrastructure investment manager in New Zealand. So, okay, if we step back and think about what we're trying to achieve, for a lot of typical institutional investors, this is primarily a low correlation strategy. And for all the CFA candidates out there, an allocation to infrastructure should enhance a portfolio's overall risk return characteristics, so effectively pushing out your efficient frontier. So also, as Philip mentioned, infrastructure is a relatively new asset class, and the definition can be very broad. The typical features of infrastructure investments are predictable cash flows with long duration contracts, inflation protection, often a large initial capital outlay, and returns largely uncorrelated with the business cycle. At Morrison & Co, we often talk about several categories of infrastructure investment. These include core infrastructure, which is what a lot of people typically think of as infrastructure. For example, ports, roading, regulated airports, power generation and transmission, and some PPP projects. Another category that we use is core plus infrastructure. This is where the investment bears some market risk. For example, non-regulated airports and renewable energy projects. These terms core and core plus were traditionally associated with real estate investment, but have been, I guess, adopted by infrastructure investors as well. Other labels include growth infrastructure, opportunistic or value add infrastructure. These investments typically have more market exposure and either brownfield or greenfield development optionality. It is also where we might find ourselves either acquiring from or competing with private equity investment managers. So some good recent examples of these types of investments include our own growth infrastructure funds investments into Sundrop Farms, Flow Systems and Infratil's investments into Vodafone New Zealand and Retire Australia. A continuum of care village or care facility is social infrastructure, providing an essential service. Prospective residents are choosing your facility in a competitive environment, and these companies often have a combination of brownfield and greenfield development options. What I've observed in the market is that when we're at a low point in terms of pricing, investors focus on what we consider essential infrastructure. So the airports, roads, and regulated utilities. When assets become more scarce as a result of increased competition and capital inflows, which is the situation we find ourselves in at the moment, managers then look to more hybrid transactions. Definitions can be somewhat amorphous. When we acquired Canberra data centres in 2016, it was from Quadrant Private Equity. CDC was very much growth infrastructure, and it still is, but it's starting to be priced like core infrastructure. In 2015, we came very close to acquiring Australia's largest telco tower company, Crown Castle Australia, now Axicom. We priced our bid on the basis of the assets being growth or value-add infrastructure. But the explosion of mobile phones and data usage since then has made these assets a core piece of infrastructure. Ultimately, when we're looking at infrastructure investment opportunities, we need to keep in mind the perspective of our clients. When they are looking at infrastructure, they are typically looking at it from a risk perspective. Will owning these assets achieve the desired outcome of the infrastructure allocation? So an investment opportunity might look like a great deal, but if it has a risk profile that is too close to real estate or the broader market, it might not make a lot of sense within the overall portfolio. Conversely, investment opportunities might not look like traditional infrastructure, but the evolution of the market or technology has resulted in them having strong infrastructure characteristics. And it comes down to the investor to continually review the infrastructure characteristics they're looking for. The final point I'd make here is that infrastructure investment is often viewed through an equity lens. There are also opportunities to invest through debt instruments or hybrid debt equity structures. This might make sense where an asset is clearly infrastructure, but the geographic risk profile is outside the bounds of an investor's comfort zone. A recent example of this is an investment of ours into Pacific broadband satellites. A satellite project is telecommunications infrastructure. The Pacific One satellite provides high throughput broadband internet to rural and remote populations in Southeast Asia and the Pacific Islands. These are locations where terrestrial networks aren't economic, as the populations are highly dispersed over large areas and island archipelagos. Our client liked the project and the strong social impact angle, but couldn't get comfortable with the risk-return equation at the equity level. So our solution was for them to invest in the project using a mezzanine financing structure with some equity exposure. Okay, sorry. I haven't talked for this long for a while. With some equity exposure gained through a warrant instrument. So structuring to facilitate downside risk protection and an asymmetric return profile enabled this investment and ultimately the entire project to happen. So I'll hand back to you, Philip.
Great, thanks, Michael. Just going to a quick follow-up question for you, just on the point around the sort of subsectors, you know, the outlook in a post-COVID environment. So obviously, you know, there's, I guess, questions around the defensiveness of some assets as a result of, you know, what we've seen so far this year. But, you know, what are your thoughts on you know, on a medium to longer term basis, which hopefully we're assuming is post-COVID?
Yeah, sure. We've obviously had a lot of near-term impact with our airport assets. So the obvious example being Wellington Airport, and I'm sure everyone's seen, you know, the impact on Auckland International Airport in the media. I think the thing for us with those assets was really to engage with our banking syndicates early and shareholders to ensure that there was sufficient liquidity to weather the storm, and also to have discussions about, you know, potential covenant waivers and things like that. I think, you know, the thematic around global mobility is still real, but, you know, there's a near-term value impact with these assets, and that's certainly been recognised and priced in now. But we still remain committed to that sector over the medium to long term.
Okay, so there's some great questions coming through. I'll start to work our way through those questions. Paul, there's one there which is perhaps linked into some of the comments you made earlier on. So, how often have publicly funded infrastructure projects actually achieved at least the required 6% rate of return? And that should contribute to the debate of whether the rate is too high.
I knew. I think we always that we knew. So we don't have transparency on those often. So you know, the best projects, particularly at the government level, will go into a post implementation evaluation. NZTA does that, for example. But it's pretty qualitative. It's not a review of, we went into this project expecting to have a benefit cost ratio of 1.5 times and we achieved 1.2 or 1.7. It's highly qualitative. I think it goes as well to, from a government perspective, that sometimes infrastructure is there to achieve wider integrated outcomes, what Sophie was talking about before. And it's actually difficult to break down those outcomes in terms of where they appear and what you aggregate. So it's a bit of an excuse for the government there. I think that they still need to try and do that. But I think that 6% real is pretty heroic in this current environment. Infrastructure investment has been proven past the last GFC and other crises to be a fantastic way to reflate the economy. And it's because it provides public benefits spread very, very widely, which really is sort of often the core role for government. So there is a role there for making sure we have good financial disciplines and that we're earning good rates of return on that. But to some extent, it's also a core role of government. So the benefit cost ratio should be a good check and balance, but they're one point of the investment decision-making framework and not the sole one.
I think what I've seen, if I can chip in on that, is that I've seen the 6% real discount rate as being the standard used by Treasury, and that's often used, I think, in those cost-benefit analyses where you're comparing different options. And so to compare them on a like-for-like basis, you use 6%. But then when you move on, when you've chosen your, best option on that basis, then for some of the bigger projects, I've seen them create a project-specific discount rate based on that, preferred option, and that might be a more realistic view of the, financing that you could get, or the rate of return that you could get on that project. But I agree, 6% shouldn't stay for years on end in the current environment in particular.
Yeah. So there's a question there which is obviously very, topical and across the broader investment industry. And the FMA has obviously just released a paper on looking at fees for KiwiSaver funds and the degree of active management. So there's a question there around fee structures for the sector. Perhaps, Michael, if I can get you just sort of talk about how you ensure within the funds that you manage, how you make sure that fees are aligned to ensure that the appropriate incentives and outcomes for investors. I think it's important, obviously, in this debate. Is alignment is important consideration, and there's a tendency, obviously, just to focus on fees in isolation without sort of looking at the the degree of value add. But I'll turn that question over to you.
Yeah, sure. This is always a really controversial topic, and I need to be careful what I say here. Look, I think the fees that are paid from Infratool to Morrison & Co are fairly transparent. The management agreement online for anyone to see. What I'd say about performance fees is that that's only on international assets, and the performance fee hurdle is 12%. And that's an absolute return hurdle. So you need to bear in mind that this vehicle was established in 1994. So the 10-year government bond rate was around 7% at the time. So implying a kind of a 5% margin. Now we're down near zero, and that implied margin is probably getting up to 11–12%. So it's actually made it much harder for us to find investment opportunities that are going to reach or exceed that hurdle. So when we do, I think, you know, that performance is certainly earned. The base management fee really reflects the complexity of trying to originate and execute and actively manage these portfolio companies that are in the portfolio. It's a very different proposition to a listed investment environment. And the final point I'd make is that, you know, you compare that hurdle to a typical private equity manager. They're at around 8% and they're targeting 20+% returns. So it just needs to be considered in that context.
Okay, great. There are a couple of questions on transmission gully. One is regarding the how realistic is the September 21 date, and regarding the delay. Who amongst our panellists would like to talk to transmission gully?
I'll kick off. Go on, Paul, you kick off. I'll follow on.
Oh, I thought you were going to take that one off me, Sophie. Same as Michael just kicked off, I think this is always a controversial one. So I think context is really important. So my understanding is that NZTA has about 75 different roading contracts on its books at the moment, and it has 75 different variations of one form or another to write out. And that's because of COVID-19 and a whole bunch of other things. So transmission gully, you know, it's a PPP, which obviously is a fixed terms contract. So it provides very little scope for variation of those terms without partners coming together to negotiate them. So I think at the very highest level, if you were to design a contract to give you the flexibility to deal with COVID-19 and earthquakes and consenting problems and other problems that project has had, a PPP is not the instrument that you would have chosen if you had perfect foresight. But it is really important to understand that Tiwai Hanga, the Infracom, which is going to do a review of that particular project, if I was to talk to them, I would say that you need to have the context of how the wider, at least all of NZTA's 75 projects have performed. Because you'll find that design and construct, which is sort of like a cost plus contract, if you like, or alliance contracts or PPPs are all going to have particular problems in the next little while. So I think that that review needs to have a look at that. And the second part of that is that PPPs aren't perfect, but they are one of the very few ways that infrastructure investors can provide capital to achieve public outcomes in New Zealand, the New Zealand market. My personal view is that at the moment we've taken the brakes off on government spending. You know, there's 15 billion of new government funding that's gone in at least to the infrastructure sector this year. But, you know, in the context of a 300 billion stock of infrastructure, and perhaps it could be 500 billion or whatever that we actually need, I believe that we're always going to need a set of tools and channels that private investors can come in and provide some diversity of thought, some diversity of approach and some innovation, some different risk approaches as well to our government friends. And if it's not PPP, then it needs to be a few other acronyms going forward as well. Otherwise, if we simply have a single way of doing things here in the market, we won't get the diverse outcomes and the progress and the innovation that we need in this market. And then Sophie can pick up the real answer after me.
I don't think there is a real answer. I wasn't going to hazard a guess as to how realistic the September 21 date is for completion. But I would say that, you know, it's not, if there's, you know, 3 months delay from COVID, then there's going to be 3 months delay at the back end, because there's a whole load of construction programming that goes into completing a project. for a fixed time and a fixed price. And if that gets impacted, then it's likely to have, you know, a higher effect than just, you know, like for like 3 months to 3 months. I think that they had some people, you know, people coming in from overseas that have been impacted, but also that level 2 and level 3 impact on, you know, disruption to the project, having lower levels of productivity. It just takes that bit longer to deliver. But what I would hope would have happened, and I wasn't party to the negotiations at all, but what I would hope to have happened is that they have a realistic idea of how long it would actually take to deliver, and that that September 21 date is now quite realistic.
In terms of new infrastructure, there's a popular question there, which is when should we expect to see shovel-ready projects coming to market, and in what sectors?
So the standard criteria for shovel-ready was that shovels needed to be in the ground inside 12 months. And there'll be a range of different times in there. There's different complexities. There was a very wide spread of projects applied for, and there is literally hundreds. So there's quite a wide variety from quite small to larger projects. And again, so all sectors, 80% of bids came in from the government sector. So, you know, probably 20% came from the private sector. I'm not sure in terms of the final list of shovel-ready projects whether it followed that 80-20 perspective. But if people on the call are interested, go to Crown Infrastructure Partners website, and the full list of projects is available there to be downloaded. What they're doing now is they're finalising the funding agreements, and once those funding agreements are finalised, then they can move into the delivery phase. But those funding agreements are a project-by-project negotiation, which is causing, I suppose, some of the approach between speed and getting these things done quickly. Yeah.
Okay. Question here probably for you, Michael, but others welcome to add as well. So are infrastructure investors beginning to price the risks of potential liabilities that may be incurred as a result of climate change into their discount rates? And what are some techniques that are being used to do this?
Yeah, that's a good question. I'm not sure it's uniform across the board. It's certainly an element that we're starting to turn our mind to. I guess there's two ways you can go about this, and it's really, one, you try and factor in some kind of cost element into your cash flows directly, or you look at a specific risk premium in your cost of capital build-up. But like I said, it's something that's really just starting to gain some traction or some interest. I think more broadly, when we're thinking about our investment themes, clearly decarbonisation is one we're very focused on, and how do you access that? Well, the obvious way to do that is through renewable energy projects. So again, when we're building up, I guess our cost of capital and cash flow assumptions, they feed into those directly as well.
I might just talk about that as well. For you know, projects that are at risk of impact from climate change, I've seen for specific projects where they're looking at what Michael was saying, adding some risk pricing in there. If they're able to mitigate against some of those risks, for example, you know, sea level rise for developments that are next to the coast, then factoring in, you know, potentially raising level of land or protecting against that sea level rise is something that I've seen. But where you've got a very, very large cost impact and relatively low likelihood, then those kind of things might be factored in from the you know, discount rate and the cost of that, rather than adding to the cost of the project, because it's very hard to price that in to the cost of the project.
I could chip in as well. So I suppose the Zero Carbon Act makes it a legal requirement for New Zealand investors, and therefore directors will be looking at that closely. There's the global rise of sort of the ESG or responsibility funds and green mandates, I suppose, that are going to potentially push that. A shout out to Adrian Miller, who's on the call. So she's just moved over to the Infrastructure Sustainability Council of Australasia. Those sorts of techniques, you know, or in the property space, you know, the Green Building Code, those sorts of rating agency type approaches to infrastructure are coming, and I think will particularly gain some traction in the government space. And the final one is in the Resource Management Act. Tony Randerson has just put down a review of our Resource Management Act and recommended sort of splitting those into 2 acts and further an act on climate change and mitigation. So again, if we're thinking about 80% of New Zealand's existing infrastructure being government-related infrastructure, there'll be a specific stream, I think, that will have real focus on that Resource Management Act part of it.
With respect to the directors' obligations, you know, the Sustainable Finance Forum's legal opinion, which was released last year, prepared by Chapman Tripp, I think, and you know, that's publicly available, but it's you know, obviously just, you know, stating directors' obligations with regard to you know, taking account of climate change risks. So couple of other questions, or a number of other questions, which we'll try and get through in the time that we have. We've got just about 10 minutes left. Just on the cost of sprawl and congestion being very high, huge costs in new developments, council, so people and families living in new distant suburbs have huge travel costs, both in time and money. Do your panellists support more greenfields or more brownfield developments? Anyone like to talk to that question?
I can have a crack if you like. I think, again, transparency is really important. So there are a whole heap of costs that we don't currently bring to bear. So a commute is a real cost, but it's often not factored into our decision making at the moment. Some things are seen as free if they're not directly priced. So I would argue that the classic economic type approach, if we should have the beneficiaries of infrastructure pay for their costs, and the disbenefit should also go into our future infrastructure investment as well. I think that with the government's urban growth agenda, it's going to be coming up to a bit of an interesting point where some of the brownfields developments are going to be high economic costs, but they're also going to be high social, environmental and cultural value. And so we're going to find that real trade-off between the traditional way that over 30 years that New Zealand governments have invested, which is really on an economic basis, the market will provide, at the cost of those other 3 well-beings. So I think we're about to see a bit of a, you know, an oh shit moment, actually, as people like Kaingora come to do major developments and look to invest in the brownfields. So I think that the sooner we come to understand the costs of brownfield versus greenfield and fully price in the externalities, I think that needs to come to bear really, really quickly, because 87% of Kiwis live in an urban area. That's not going to get less. And our cities are the places where we innovate, and we also have the best chance of meeting our climate obligations and future way of life. So we've got to get our urban centres right, and that cost of sprawl, which is related to the cost of infrastructure, is one that we don't have right yet.
I think that's just to add to that, something else to think about is not so much is it more greenfields or is it more brownfields, but making sure that the risk allocation of each is well understood and applied. I think that, you know, companies see that, or, you know, construction contractors see greenfields as less risky for them because they have more control over what's there and what happens. With brownfields, it's really getting to understand what's actually usually underground or what's actually there, and who takes the risk on that. And so making sure that that's fairly allocated and reasonably allocated and priced is going to be key.
Okay, a question that's got a couple of likes there is regarding KiwiSaver investment, which is a point that I touched on in the beginning. So what regulatory changes in the panel's opinion could encourage an allocation to the unlisted infrastructure asset class? And I mean, I think scale is certainly a real consideration here. So, I mean, the industry here has grown a lot, as the question points out, 70 billion. But compare that obviously to the Australian super funds, where the largest funds are by themselves are a larger multiple of that number, and so it is definitely an asset class which does require scale, but at the same time also requires sort of avenues for funds to to allocate to the sector. And there's probably a related question there for you, Michael, in terms of the opportunities for infrastructure private investors in New Zealand. What are the opportunities from small investors to large institutional?
Do you mind if I tackle that last one first, Philip?
Certainly, yep.
Yeah, okay. Look, I actually think it's pretty hard in New Zealand to access this asset class. I think for your small private investors, you really have to look to the listed markets, and it might sound silly, but you could buy infrastructure stock, I suppose. Other than that, you'd just be having to look at other listed exposures that have those infra characteristics, whether it's airports and ports and things like that. I don't think there's many avenues for private investors to access, dedicated infrastructure funds. I mean, there's probably ETF products that they could use as well. So yeah, there's a real market opportunity there, I think. And then at the larger end of town, I think the deal flow of what you would consider core infrastructure projects and opportunities in New Zealand is pretty lean at the moment, and that's partly to do with the current government's views and policy settings. That's not to say there aren't opportunities there or things that have infra-like characteristics. So I know the New Zealand Super Fund has made a couple of investments recently that would have infra characteristics. But yeah, I mean, it's certainly a challenge. I mean, you're probably going to have more success if you look offshore, and our firm strategy is certainly to do that. So the key markets we're looking at are Australia, UK, Europe, and the US, where the deal flow is pretty strong even in a COVID environment. I don't know, Sophie, if you want to pitch in on that one.
I think you've done a good job, Michael.
All right, so we're just about out of time. I'll just see if our panellists have any final remaining comments they just wanted to add. Just get the last word in at all. If not, then we'll see if we can find another question.
I'll just add one final comment. I think Sophie nailed it early on, that infrastructure often is a really integrated play. When we were in Whangarei earlier in the year, the hospital there was in a dire strait and needed a lot more investment. But without using the pun of the ambulance at the bottom of the cliff, part of the reason the hospital was in dire straits is because of the lack of quality housing, the lack of decent roads up there, and the lack of jobs and some other socio-economic issues. So there is a huge opportunity for us, but we have to get out of planning infrastructure in silos, put people at the heart of it and communities at the heart of it, and allow for flexibility for future needs and that diversity of thought that Sophie mentioned. But at the heart of it, successful infrastructure requires partnerships based around people and future needs. And we have underinvested in our infrastructure for quite some time, probably about 3 decades, thinking that the market will prevail. And in some sectors where it's been regulated, that has happened, and it's performed really well. But for the rest of it, it is a huge opportunity with COVID and the funding to really be future focused about what sort of New Zealand we want to achieve, and then partner up iwi, community, business, local and central government in order to achieve much better outcomes.
I just echo that, and also to just point out that an outcome focus is something that's been talked about more and more. It's not necessarily done that well. It's quite often just output, say build a road or you need to build a hospital. What are you actually trying to achieve? And so really targeting those outcomes and being explicit about what you need from your infrastructure is something that I think is a big opportunity in New Zealand.
Excellent. Well, those are fantastic final words to sum up. So that brings us to the end of the session. I'd like to thank the panel. I'd like to thank all of you who dialed in and to listen, and also to the CFA Society and to Kylie for organising. So